You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, so with the vein of the market choppiness that we have talked about recently, we're going to look at another SPX trade this week. And as always on Options Playbook Radio, it's about trying to take the current market conditions / pricing conditions of the options marketplace and look at the whole plethora of strategies in the options playbook and look at strategies that might apply. So last week was January 4th when we taped Options Playbook Radio. It was the first episode of the new year. And we started with a little bit of a bearish trade. It was a butterfly in the S&P 500 index. And once again, it was because we saw the VIX index elevated up above the 20% level. I'm trying to think, I think it was around 23, 24%. And that makes things like butterflies, where you're going to be selling two option contracts to form that butterfly, cheap. So higher implied volatility makes butterflies cheaper than lower implied volatility. So ideally, when you put on a butterfly, if you are correct on your forecast, you want implied volatility to go down, because that means that if you're correct on your forecast, the market is going towards your middle strike of your butterfly. And that middle strike, you're short two option contracts. And you need that premium to come in, or those price of those options to decay. And that's the only way you can make the maximum on a butterfly. So when we looked at our trade last week, it was literally a speculative trade saying the markets had a fairly strong period over the holidays, flat to strong, I guess. And we see a little bit more headwinds going into the new year. Let's just look at a very short-term move that we're expecting in the S&P 500 index. And we did a two-day butterfly. We put the trade on. The markets were closed at the time when we looked at it. And as always, they're paper trades when we're talking here on Options Playbook Radio. Nothing's ever meant to be a recommendation. We're just trying to learn. And with that said, though, the market the next day came down and actually hit our short strike. It was a two-day trade. So on Thursday, you would have been out of the trade. And then on Friday, the option contracts would have expired. But you should have closed it out the very next day. As always, we say with butterflies, we looked at doing a 20-point wide butterfly. The maximum would be 20 points or $2,000 for every 1x2x1 butterfly. But if you ever make that $2,000, you're supposed to get the stupid award for it. And here's the reason why, in that you really shouldn't stay in the trade all the way to the end. If you ever get something where you do a short-term speculative trade like that, and it does hit your short strike, you take the benefit, you take whatever profit you may have, and you move on. And it's usually going to be hundreds as opposed to thousands. Mainly because if you're looking at a big index like the S&P 500 index, it takes a lot for those option contracts to decay. And when we looked at our trade from last week, the market was at 38.52. We currently see it at 39.71, so the market has made a strong move to the upside. We had a good CPI number this morning, actually. And we needed the market to go down to 38.30. Those option contracts, we taped that on a Wednesday. You had 2 full days of trading for those options to live. And that option contract, the 38.30, was trading at the midpoint of $22. So you needed that option contract to go from $22 all the way down to $0. And that's going to happen at expiration, right? Especially if it's an out of the money option contract, all that time premium is going to go away. But with that said, that also means you have a huge amount of time decay over those 2 days. And that's part of the reason why we set up the butterfly in the S&P 500 index. Okay, so markets have done better. They went down for a couple of days. They helped us out on our trade. Recently, we've had fairly decent news. Inflation is going the right direction as of right now. And I should let you know that we're not taping Options Playbook Radio on Wednesday. It's Thursday today. The date is the 12th of January, 2023. And CPI numbers came out this morning, and they were positive. The CPI is going in the correct direction. It was down on a month-over-month basis, just a fraction, but the fact that it's going in the right direction is a big deal to the markets. The markets are up right now. And as I mentioned, we see the S&P 500 index trading close to flat, actually. I say they're up, but it's only up $2.90. 3,972.51 is where the S&P 500 index is at. That's going to be the index that we're going to use today. And we actually saw the VIX for the first time break below 20. So it's been a long time since the VIX index has breached the 20% level. It's currently trading at 1939, down $1.70 on the day. And since the pandemic, since the market volatility that was generated from the pandemic, 20 has really been a line in the sand. You can almost call that low volatility. Over history, I wouldn't say 20%. 20% VIX over the last 10 years was low volatility, but that's where the market is at. That is where the new line in the sand has been drawn, and we breached it. We're at 1939. So the marketplace felt really good about the CPI number, at least the VIX did. So a lot of angst in the marketplace, a lot of the nervousness has came out of the marketplace, and that's what the VIX is showing. Now, forecast going forward, well, we're running into earnings. That's going to probably be the next big thing on the economic calendar. Is this Friday is kind of the non-official kickoff of earnings. We'll have a lot of banks that are going to be come out announcing earnings, and a lot will be said about what people are saying after their earnings reports. The guidance, that's the word I was struggling with. The guidance that a lot of companies will be giving. Now, during the pandemic, a lot of companies just chose not to give guidance. But in this day and age, I don't know if they can get away with it as easy. A lot of the guidance is expected after their earnings announcements that are coming up. And the main reason why I say that is there's going to be a lot of questions about layoffs. We've had a lot of big companies recently announced that they're going to be laying off people, and that's the one sticky side of the equation that the Fed is concerned about. They would like to see higher unemployment, even though they would not voice that publicly. But the strength of the employee and the wage growth has really been something that the Fed has seen to drive the inflation higher. So we got a decent number. The Fed is still very hawkish. The Fed still has a goal of getting the Fed funds rate. They haven't gone away from their goal of around a 5% level in the Fed funds rate. The 2-year note is actually came down quite a bit, kind of hinting that maybe the Fed might be a little bit less hawkish going into the summer months, but the Fed is not leaning that way. But the markets are implying that because we saw the 2-year go from 4.5% down to around 4.2%. Usually the 2-year note will interest rate on the 2-year note will increase close to the terminal rate, which is the rate that the Fed it's the point where the Fed will stop raising interest rates and maybe consider cutting, I guess, for lack of a better term. I don't know when this Fed would consider actually cutting interest rates. They've never given any hint to that so far. All right, so I see chop. I think the fact that the SPX is at 3971, going up towards that 4,000 level. That 4,000 level is just, that magic, nice, big, round number. I think we're going to struggle around that level. And because of that, and we still got an elevated VIX, 19%. And I do think that the VIX could come off a little bit too. Let's do a strategy that takes advantage of a decent VIX number and probably choppy markets going through the earnings period. Even if the earnings, I expect earnings in general to be decent, but I do also expect that there's going to be cautious words as far as guidance is concerned and potential layoffs. And that's going to be the big thing. Are you laying off people? Where do you see the jobs market going? Those are the type of questions that CEOs and in general companies are going to be asked after their earnings announcements in their public addresses. All right. So let's do it. Last week that trade worked out. It worked out because, we had a real good move on the very next day after we talked about it on Wednesday. And the market did actually go down to the 38.30 level on that day. Then you should have closed it out on Friday. The market actually had a fairly strong day and came back. So if you didn't close it out, you missed out on your opportunity. So with that said, though, we've always said, if you're doing a short-term speculative butterfly, it hits your short strike, you just want to get out. Even if it's not the gain that you were anticipating, which sometimes happens. It's better that it happens closer to the expiration date than not. But in this instance, we're going to be looking at kind of a similar situation. But I'm going to put some protection in. Last week on the butterfly, we were all about speculation, and speculation means we're doing shorter term options, in my mind, on these type of strategies where you're using a big index, very expensive index, and you're hoping for time decay. That is exactly what we're doing with the Air and Condor, but we're going to spread it out. Now, by going out further in time, we bring in a bigger credit, but I don't anticipate that we're going to ride this all the way to the expiration date. So let me give you the trade and tell you the difference between my thoughts on this Iron Condor that we're going to talk about today and my thoughts on the actual butterfly that we did last week in the same index. So if I look at the S&P 500 index expiration, there's so many to choose from, and you want to make sure that whenever you're looking in the S&P 500 index, sometimes you will see options inside the chain that will have the same expiration date. One is an American style option and one is a European style option. And it matters a lot. If you look at the American style options, they will stop trading after the close on Friday, and the European style options will stop trading after the close on Thursday, and the settlement is determined by what happens on Friday morning. So the SPX is by far the most confusing option chain that is in the retail markets, at least the U.S. retail markets for sure. Okay. Well, I should say markets, not necessarily retail markets, but in the U.S. markets. Okay, so here's the trade. We're going to go out to the February 3rd expiration. That has 22 days until that expiration date. We've got the market right now at 39.71. I took a screenshot of it. The markets are moving, so I just took a screenshot of the trade, got rid of the streaming quotes, and here's what we have. We're going to go and look at Delta. We're going to sell the 20 Delta put, and we're going to sell the 20 Delta call, implying that on its own, in a vacuum, that there is at the expiration date, and that's what Delta is kind of saying, that there is a 20% chance that the index will be at least 1 cent in the money by that expiration date. And that would also be the case on the call side. Now, you have a benefit in an iron condor in that the market can only go one direction, right? It can't go up and down at the same time. So you have a higher probability of success in that one, well, I shouldn't say higher probability of success. What I should say is that one side of your iron condor should be doing well if the other side is not doing well, right? So we're going to go, and by selling the 20 Delta put and selling the 20 Delta call, we're going to go 10 points out and we're going to buy our wings. The 20 Delta put means that we're going to be selling the 38.15 strike put. Hence, we would be buying the 38.05 strike put as our hedge. And on the call side, that means that we're selling the 31.20 strike call, and we're going to be buying the 31.40 strike call as our hedge. The call is around 148 points out of the money, where the put is around 156 points out of the money. And that is common. There's skewing in implied volatility. Implied volatility is going to affect the deltas. Everything affects everything, right? And volatility, time, all that affects the price of an option contract. So this is where we're at. We have, if you do it on a percentage basis, you're looking at about a little less than 4%, 3.9% on the put, 3.7% on the call. We'll call it less than 4%. Let's use that terminology. A less than 4% move in either direction over the next 22 days. So what we're kind of hoping for is some chop in the market, and don't expect the market to just stay where it's at, but a little, up, maybe bump against the 4,000 level, come back down, take some time before we can break through it, maybe go a little bit to the downside. But overall, the market is still not through all the concerns of the Fed, possible recession, what we still have going on in Europe. We've had some decent news in China, but who really knows? It's China. Is everything they're saying up and up, et cetera, et cetera. Okay. So, market's at 39.71. We're going to be selling on the put side the 38.15 put, buying the 38.05 put with the February 3rd expiration, 22 days away. On the call side, we're going to sell the 41.20 call, buy the 41.30 call. Once again, same expiration, February 3rd, 22 days away. We can get this 10-point wide iron condor done for a net credit of $3.80 to your account. That means you're going to bring in $380 less commission, and that would be the maximum you can make on your trade. The maximum risk is the width between the strikes, which is 10 points, minus the net credit received, which is $380 or $6.20. That's the net debit to the account, and that's $620 for every one by one butterfly that you do. All right. Now, here's the one thing that I wanted to address, and I thought that this played well together, considering we looked at the very short-term butterfly last week as a speculative downward move over a couple day period. When we're looking at the iron condor, we want time decay to happen. And so sometimes people will say, well, if I'm looking at an iron condor, why don't I just do a 1 week iron condor? And my problem with that is that you now need the market to stay within a range. And if you're doing this iron condor, the market's probably going to move, right? One side's going to move against you versus another side. And if it moves really quickly against you, it's very hard to adjust or adapt the trade if you have very short-term option contracts. And in the butterfly, I would rather have the ability to maybe even get out of one side of the trade. So, for example, if this market does move against you and you have a 22-day option contract, it won't hurt me as bad if it happens right away because the time premium of the put that we bought will help offset some of the losses on the time premium of the put that we sold. And it's just that it takes a while in the S&P 500 index for these option contracts to decay, and that decay adds safety to that slow time decay adds safety to your trade if you're wrong on the trade. You can also then adjust the trade if you would like. So if I'm doing the iron condor, I don't mind legging out of the trade either. If it is going towards the put side of things, and I want to close out my call spread because I have a decent gain on that side, I may do that. It all depends on where it is in the timing to expiration and what I plan to do with the put side of it. But I don't mind legging out of it as spreads, either as a short put spread, buying to close it, or as a short call spread, buying to close it, and removing the risk on that side. Now, the upside of the iron condor is that as far as the requirement is concerned, only one side should be held out. Why? Because the market can only go in one direction. So the maximum that you can lose in this trade is going to be that $1,000 minus that $3.80 that was brought in. And you can only either lose that amount because the market went down, or you can only lose that amount because the market went up. Now, $3.80, that's a decent credit. And that has a little bit to do with the VIX just being right around that 20% level. We're getting a decent credit on the out-of-the-money option contracts on a 10-point wide iron condor. That also gives me a little bit of protection in that if I have that type of credit, I don't need to make as much in a short period, right? So let's say we did this iron condor and it was 10 points wide. And we did it 1 week out and we brought in $1 credit. Well, if I brought in $1 credit, I'd really like to try to at least make $1, right? That means I'm going to have to ride it all the way to that expiration date. That may be a thought. That might be why we did a 1 week iron condor. Whereas if I have $3.80, well, you know what? I can just close it out after the time decay awards me $1, $2.80. So I have a different mindset. I'm not riding it all the way to the expiration. And as we get closer and closer to the expiration, that's when these short spreads become scary, because if the market moves hard against you and you have no time premium in your option contract, the delta of an in-the-money near-term option is going to go to 1 very fast. So a lot of traders on the floor, whenever you get down to 1 week to expiration, they just close out trades. They close out short spreads because they're just like, I don't want that risk, because if it goes against me, it's going to go against me hard, and it's going to be very hard to adjust or even close out the trade. All right. So the big difference here between the butterfly we talked about last week, which was 100% a very speculative trade because it was so short term in what we needed the market to do just in general. This I look at as, all right, this is a trade that I could do every month. And especially if our outlook going into their earnings season, going into the summer is, if anything, path with least resistance, maybe to the downside as far as if I had to pick a way to look at it. But I really just expect chop. I expect a lot of chop in the marketplace. So this is a strategy that until that forecast changes, I could continue to do it at the expiration of this contract or whenever I close it out, look at doing it again. You have so many different expirations, staying 22 days out, or even going to 24, 25. It's very simple to do that with the SPX option contracts. Now, also with that said is, if I got down to a week to expiration, I'm probably just going to close the trade. Even if I was just, let's say I was break even. So for a net credit of 380, I could get out for a net credit of 380. I would probably still do that because I just don't want to be in this situation where I don't have the defined risk like I did. Well, I do have defined risk, but the risk reward ratio is much different than it was on the butterfly, right? I had a very, very minimal risk. Actually, the butterfly that we did last week, we paid $1.90 for it. That meant we had $200 in risk for every 1x2x1 butterfly that we did. $190 plus commission approximately. Not approximately. That's actually what it was. And that was our midpoint, and that was our total risk. Now I have a situation where we're trying, the most we could make is $3.80, and the most we could lose is $10. So our total risk is $6.20. So that makes me change things. Makes me go a little bit further out in time. It makes me just have a different approach on this trade in general. All right. Well, that's it for this episode of Options Playbook Radio. If you have any questions you'd like to discuss on the show, please email them to me directly at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.